Second side, RBI kept ample liquidity into the system to fuel growth. What it provided us as an opportunity was, one, in terms of refinancing some of the existing debt that was sitting with some of the other banks. Second, it gave us an opportunity. There were a set of companies who were very uncertain about future and wanted to keep ample liquidity on their balance sheets, and they ended up taking working capital drawings. Third is, we participated into the TRO program, and we were one of the most active participants on that particular space. There were certain green shoots, there were opportunities on the capex side, and that is what we participated in. While everyone was working from home, we were working in a manner that how do we facilitate work from home better. And that is where we ended up integrating with a lot of our corporate clients on their ERP platforms. And today, as we speak, 94% of transactions, collections and payments are straight through processing at HDFC Bank. 87% of trade is untouched by human hand. So we today are one of the largest movers of cash in the country, and I'll cover the volumes as well, but we managed to digitize. So for us, pandemic acted like as a catalyst to grow our volumes. Over the last 6 months, what we've seen is while private capex has been subdued, government expenditure has been high. There has been asset monetizations. There have been InvIT structures that have come in. There is a production-linked incentive scheme of the government wherein fresh capex demand is visible, and we continue to participate in the growth opportunity. The other thing that people witnessed was in terms of supply chain disruptions. It's not only in terms of the price, but also in terms of availability. And all large companies wanted to stitch up their supply chain better, and both in terms of financing and two, in terms of settlements. So we did a lot of work there. In Q3 of FY22, we launched an altogether new supply chain platform. So while whatever I said, what did it translate into? It translated into a 15.7% growth over the last 1 year in my corporate book, in spite of foreclosures which were never seen before. How does this compare? If you look at large credit growth, large corporate credit growth was 0.9%, and we grew at 15.7%. So we were growing 16 times faster than the market. If we see it over a period of 2 years, we have grown at a CAGR of 22%. The good part is the book has been carefully built. Now, different ways in which you can cut this particular book, and we cut it in multiple ways. One way of looking at it is in terms of the breakup of the book between PSUs and non-PSUs. Today, 62% of the book is non-PSU, 38% is PSU clients. If you look at it in terms of both parts of the book have been growing well, the PSU book growing at 13%, non-PSU growing at 17%. The other way you would cut it is in terms of the rating of our customers. My PSU book today has an internal rating of 2.84, which typically translates to AAA. My non-PSU, domestic large company book, carries a rating of 3.83, which is where at the portfolio level would fall somewhere between a AA plus to a AA at a portfolio level. If I was to just look at it a little differently, today AA, AAA rated customers constitute 93.5% of my book. If I was to look at AA and AAA, it is 87%. And pure AAA customers are at 49%. It's not only in terms of the cut, but even when you look at it from the point of view of industry exposures, we are well spread across industries. There were certain industries where we witnessed better growth. The growth came in from agri, food processing, beverages. It came in from infrastructure spends. It came from telecom and services. There were certain sectors like telecom, pharma, chemicals, which saw more cement, which saw more foreclosures during this particular period. The beauty of the book is that it has been built in a manner. So while we look at this particular book composition, there is a lot of science that has gone behind the book in terms of whether it is the mix of working capital and term, even within term, what is manufacturing, what is infrastructure, what is greenfield, what is brownfield, in terms of rating-wise distribution. So you typically end up having a larger tenor book in better rated companies, and as you keep going down. So in terms of historically, this is a business that the bank has built, and we are very proud of the pristine book that we've created in this particular space. Now, putting out asset is just one part of it. Our journey is actually in terms of how are we participating in the larger ecosystem of our corporate clients. And that is where working capital and term is one part of it. How are we facilitating their international trade? How are we moving cash within the country, whether it is collections and payments? How are we adding value by funding both the customers and the vendors of our clients? How are we actually providing digital integration? What are we doing for employees of our corporate clients? What are we doing in terms of tax collections? How are we distributing all the profits corporates are generating by way of dividend distribution? So this is one department that does not work only for corporate bank but works for the entire bank. And in true sense, it's one bank that we deliver to the client, because some of the products that we offer to our corporate clients does not sit in my BDP. So just to touch upon some of these products, today I have amongst corporate clients 2,000 odd relationships where I have a salary relationship. We have 44 lakh employees working in these 2,000 plus companies who have their salary accounts with us. Now this has grown at 14% over the previous year. If I look at balances in these salary accounts, it's 54,000 crores plus is the balance sitting in these accounts. That has grown at 21%. And I'm not even counting in terms of the retail asset cross-sell that happens on this particular portfolio. But we've leveraged our asset relationship to bring in a lot of cross-sell. In terms of trade, we are present across both products, across both domestic and international trade. We are present through domestic factoring, invoice discounting, bill discounting. We are present through export funding solutions and very well spread. We participate through the non-funded space. And again, there is a science that has gone behind. If you look at my letters of credit book, 82% of my transactions are for cross-border. This not only provides me the ability to handle volumes, but also generates FX income for the bank. If I look at the guarantee space, it's the other way around, wherein 93% of guarantees are issued for domestic purposes, where risk associated is substantially lower than cross-border guarantees that we issue. Now we handle trade not only in terms of discounting, but even in terms of document handling. So if we look at our trade volumes, discounting, collections, imports, exports all put together, we have seen a great traction wherein 48% of growth in our trade transactions over the previous year. What we have done over this particular period is integrated our solutions with the clients. So today when it comes to EDPMS, IDPMS and automatic reconciliation, that is where we add value. The 48% growth in volume has not come by magic, it has come because we have delivered a solution to the client that the customer finds useful. So whether, just to take an example, if there is an importer, he has imported a particular article, that import is physically reflecting under the DGFT data against him. We help populate that particular data on our trade on net system. The customer is able to make payment. We reconcile the physical import with the payment going out, report it to RBI and help reconcile it to the customer's end. So these are kind of value-added solutions that we have offered to our clients to actually come a lot closer and become the primary bank for our customers. If we look at pure TON, when you look at it, there is two parts. If you look at the numbers, there has been 16% growth in total transactions routed through Trade on Net platform. But if you look at digital transaction, there has been a 26% growth. So while on one side, we keep acquiring clients, keep acquiring volumes, and once acquired, very soon we try and move it to a digital platform, which helps build volumes without actually incurring a high cost of processing. I mentioned in terms of the supply chain platform that we provided, this product has a great potential, and I have a slide which covers the larger ecosystem here. But just to quickly tell you, this product will allow me to, one, do everything digitally. At this particular point in time, 80% of supply chain transactions have already moved to a digital platform. Whether it would be going forward in future, whether it is credit underwriting, whether it is loan booking, account opening, documentation, execution, all of it would be done digitally. And the turnaround time will be the best in the industry. In terms of cash management, this particular service, we are market leaders. There are multiple benefits that we accrue out of this. The first one is in terms of, for a corporate, current account float is nothing but the time gap between collections and payments. Now this gives me the more volumes I handle, the larger float I have. And we have seen data over last 5 years, there is a direct correlation between your collection volumes, value, and the kind of current account float that you build in. So this is a business where we have seen, again, in spite of a very large base, as you see in terms of number of transactions, we have grown volumes by 24% and value growth has been 35%. It's spread across industries, and we actually have a solution for each of the industries. What we have also seen is a very quick adoption of the API platforms and host-to-host integration, and the volume growth here is even higher. And this is a product that creates more stickiness around the customer. So while we've covered in terms of volumes which are unparalleled in the market, 94% of total transactions, if I split it into collections and payments, 97% of payments are straight through today. Collections is at 92%, overall at a 94%. And while I handle these kind of volumes, my cost to income is in low single digit on transaction processing. When we look at statutory payments, the total direct plus indirect, individual plus corporate tax collection in India last year was 27 lakh crores. We ended up collecting purely out of our corporate bank customers a tax of 2,25,000 crore last year. And to this, now that we have the mandate to collect e-freight, customs duty, and better engagement with clients, we are going to see the share going up. And this is only corporate bank. As a bank, the share will be even higher, but this is what we contribute in terms of corporate bank. Now, we all would wonder, why am I talking so much about transaction volumes? Now, we handle volumes for a particular reason. So if you look at my change in my liability book for corporate bank, CASA ratio was 44%, 45% as of March 21. And with all the digitizations, integrations, and garnering a higher share of volume, my liability franchise has improved, wherein my CASA provides me 50% and fixed deposits are 50%. So the quality of the liability book has improved. Similarly, whatever we do, it's for a corporate bank, it is not only about asset income. And if you look at it in terms of various, whether it is fees, whether it is FX, whether it is cross-sell, whatever else I do for rest of the bank, that is what gives me kicker on my revenues. So asset contribution to the total income is reducing, which shows the richness of what we do, leveraging on the balance sheet that we extend to these set of clients. The other important aspect is in terms of my risk-adjusted return on capital, and this is what we measure in terms of profitability. There is only 7% of my customers who figure into a high capital, low return. And if I was to be more conservative, if I add high capital, high return, there is another 1% of my book. So there is only 8% of the book today that is consuming high capital but does not generate commensurate return. Now there is a monthly review that we have in terms of how do we get these 8% customers down. It's simple, either you get the facilities rated or you improve cross-sell. And that's something that is there in our DNA that would always remain. While we talking about corporate bank business, but there is a lot of digitalization that can be built on the corporate bank also. So we have embarked on an architecture wherein we are redesigning and moving away from the legacy system into a cloud native, resilient, agile, scalable API platform, and that is where you saw in terms of the volume growth. We are redesigning both the RM journey as well as the customer journey. For an RM, what we are trying to bring in is a lot of artificial intelligence in terms of how things can be done. So whether it is in terms of providing a one view to the customer or giving him insight into what product your customer is most likely to buy, or timing of a particular sell, or arming him with information in terms of how to price your loan better, or what are peers in the same industry paying or people with similar rating paying. So we've completely changed in terms of the way an RM handles. There is another beautiful initiative that we run today that is called Perform to Potential. Here what we are trying to do is, we've realized that within the same industry, the business models are very similar. So you pick up an automobile company and you will find that there is a similar model between a Tata Motors to a Mahindra and Mahindra to an Ashok Leyland. And if you pick up a pharma companies, you will find they have a similar arrangement when it comes to their distribution. Same will be the case with all the cement companies, same will be the case with all the tire companies. So if there is something that you are doing right for one of the companies, you've understood the pain point of that particular industry, how well can you replicate it to others? And we've realized that all the engagements and volume growth that we are getting today is on the back of not providing a product, but extending a solution. And that is what the technology platform is going to help RM to do better. In terms of customer experience, we are trying to see what more can be done digitally. We are also seeing what on a self-service mode, what a corporate client can do. This, in addition to the transaction banking platform, which is on the supply chain side, in terms of the trade on net side, there is a lot that would happen. The last block is on the ecosystem banking, and we are partnering with a lot of fintechs who bring in certain specialty skills to further sharpen our offering in the market. It's not only in terms of collecting money today, but if I can do an invoice level reconciliation for a client and then directly upload it into the ERP system, the customer is ready to pay me a lot more for the services that I extend. Here, I'm just, while I've covered in terms of digital, I was told keep a lot of time for Q&A, so I'm just going to very quickly tell you. This is in terms of the client testimonials. Some of the things that they've been mentioning is that technology is very flexible, the ease of implementation, direct integration with the ERP system, and all offerings and mindset of digitizing everything. And this is what is helping us win clients at this point in time. I spoke about the supply chain landscape. Just visualize this. There is a corporate at the center. Up to now, offerings from most banks was limited to the tier 1 vendor. And now we have developed capabilities of even doing tier 2 vendor finance. So this is the deep tier funding that we would be able to do. Corporate may be cash rich, may not require money. Tier 1 vendor may or may not need money, but definitely the tier 2 vendor definitely needs money. So how do we take the corporate risk of a cash flow and go right up to the tier 2? Similarly, there would be with GST, there are large warehouses coming. Certain businesses, you have the 2P, 3P manufacturers coming in. And if you look at it on the entire vendor side, you have large part of your credit risk is mitigated, somewhere partially and somewhere fully. Similarly, when we look at the sales side, there are distributors, there are dealers, there would be things that we would be able to build digitally, and picking up with the consent of the customer GST details, a lot of underwriting can be built based on customer experience or vintage with a corporate client of ours. Some of it would be with recourse, some of it would be without recourse. In certain cases, we will partner with the rest of the bank, whether it is our business banking, whether emerging enterprises group, wherein we will create a funnel of customers for them through our corporate engagement. Primarily, our competition here used to be banks, and we are looking at seeing whether partnerships internally or with fintechs, how do we actually leverage this a lot more. This is another interesting business, and this is a vision. So while we would be leaders across a lot of businesses, and more particularly when it comes to corporate bank, we would either be number 1 or number 2 across products or at an overall business point of view. This is a business where we feel growth potential is large, and this is multinational clients. We have a vision that over the next 3 years, we want to become the largest Indian bank to multinational companies in India. At this particular point in time, I have 653 odd relationships. In last 1 year itself, we have acquired 59 new relationships. If you look at composition of this particular book, these are customers who prefer to be asset light in India. But look at the contribution in terms of the liability, FX, cross-sell, salary accounts that these set of customers provide us. At this point in time, as per our identification, we have 2,000 more MNC clients that are available in the country for us to go and tap. This has been divided by country of origin, it has been divided, cut across industries, it has been divided across geographies, it has been divided across chambers of commerce or consul general. How do we attack them? To an effect that we have now a Korean speaking RM as part of the team to go and market to these Korean companies. So that is the kind of focus that we are bringing in to these set of clients and trying to see how we achieve this particular dream. The other growth driver for corporate bank, there are, and just a lot of it is not, you will do search, you will not get these details. So whether it is getting data from various industry sources, rating agencies, ROC database, at this particular point in time, there are 2,237 companies with turnover more than 1,000 crores, and that's the segment corporate bank deals with. Out of this, we have credit relationship with 1,066 customers already. Out of the balance names, if I was to do a simple filter, that companies who have rating, external rating better than A and have not been reported ever with the bureau for any kind of overdues of evidence of stress, you come across 617 companies. Now these 617 companies, between them are currently sitting on a debt of 11 lakh crores. 80% of it is term, 20% of it is working capital. It is not that because they are rated and not reported SMA, it's not that we may have appetite to deal with all of them. It is not that all of them would want to deal with me. But even if in terms of a runway for me, in terms of if I was to convert whatever number out of it, it comes and sits over what my existing customers provide me as growth. And when you compare it with a 4 lakh crore book at this particular point in time, this particular new to bank initiative itself is capable of providing us a much larger growth. The next initiative is, and everyone is talking about PLI. What does the PLI opportunity provide us? There are at this point in time 14 sectors, 16 schemes. Government has announced various investments. The total incentive announced up to now is to the tune of 2,34,000 crores. There are 2 sectors where the winning applicants have not been announced as yet. Across the 12 sectors where winners have been announced, it's 600 odd companies that are there. Some of them are existing customers of HDFC Bank. Some of them happen to be new to bank clients for me as well as other parts of the bank. We've engaged with a lot of these clients. Some of them have crystallized their debt requirements. Some of them are still in the process of figuring out their total debt needs. A lot of them are looking at raising equity. A lot of them are looking at bringing in foreign direct investment. And we are very actively engaged with them, not only in terms of participating in the debt needs, but also in terms of offering services on the FX and other products that the bank offers. Now, opportunities are large. It is for us to decide what makes sense to us and what do we take. So just to summarize in terms of corporate bank, where do we see this particular business going forward? And let me start with the existing to bank customers. One is, I will continue to work towards increasing my share of wallet on products that I have already sold to the client, and I will try to bring in new products to existing clients. And our exercise on perform to potential and benchmarking to the best and bringing in solution should help this endeavor. Second thing is, in terms of the new to bank clients, we showed you the space where we are not present. In spite of being one of the largest corporate banks in the country, there is still a lot more that can be done. Third thing is, there is an opportunity that the economy has provided, whether it is in terms of production linked incentive or it can be to do with asset monetization. We have engaged with a lot of agencies, just to take a name, NHAI, in terms of they are looking at monetizing 26,000 kilometers of road. And if you look at it lately, whatever monetization has happened, where has the money come in or who are the new acquirers? These are international companies who are coming and buying assets that are generating stable cash flows for a long period of time. So these are the kind of opportunities, whether it is through PLI or asset monetization or the capex cycle, as and when they kick in, will provide us avenues for growth. I spoke about supply chain. It is a risk mitigate tool as well as an avenue for us to lend at better yields at the same risk of lending to a corporate. So that is where it fits into our future strategy. There are a lot of new products that the corporates are asking for, which the banking system does not provide, or does not provide it as widely as the need is felt, whether it is in terms of international trade, export, factoring, and a lot of things. While domestic factoring is popular, there are transactions and structures around international trade. All of it would provide better returns than the traditional way of doing things. So we are investing into products, we are investing into partnerships that would help us grow this particular business. I have spoken in terms of the vision to be a very large bank to multinational companies in India. We do believe that digital is the way to go. So continuing to improve our platforms that we extend to clients. In fact, we are now live on threads for SME bill discounting, which would help a corporate bank to even meet the priority sector needs. So there are enough and more opportunities that still exist. So in spite of coming from a back of two great growth years, we do believe that corporate bank can continue to grow and add value to the organization. Thank you.
Wanted to just understand, are there any sectors or segments that you want to avoid at this point of time in the corporate banking space?
Not really. We try to focus on the top performers in all sectors. So, of course, there will be some sectors where we are more cautious, more wary, but we don't have a blacklist, if that's what your question is. We look to interact as actively as we can with the better performers in every sector. And of course, there are some industries that have many more well-rated companies than others. I'm talking about rating on our own scale. So that's how we go about it. But we don't blacklist anybody. You'll probably find someone from every industry on our books.
Sure. So would you like to call out sectors on which you're cautious about?
I don't think it's appropriate, given that people will be my clients. Honestly,
Okay.
Sorry.
Yeah.
Sorry about that.
Sure. Sure. And thirdly...
But did you have a reason? I don't mind explaining to you what our ethos is and what we are. If you have a reason...
So if you can just pick up a sector of your choice, and between the two of us, we can tell you how do you pick a winner in that sector.
So let's say something like a road projects, where infrastructure projects, where the right of way
Okay,
challenges.
so let me tell you.
Good,
in terms
good,
of
good one.
So, and you mentioned in terms of road. If you see evolution of funding roads, it started off with a BOT, then it moved into annuities, then it moved into EPC, and then it moved into hybrid annuities. Now, if you look at it over the years, the risk associated with funding road has progressively kept coming down. Now, what you are looking at when it comes to road, the biggest thing is that you need to look at whether are you taking a traffic risk or are you taking an annuity risk. In terms of traffic risk, what are the alternate road? If you are taking a traffic risk, and we would be more comfortable if there is an annuity over a traffic, then you are looking at alternate roads that are coming in. You look at who the sponsorer is. You look at how aggressive the debt equity mix is. You look at what kind of support that is being provided. You look at 2 or 3 other estimates in terms of traffic that would come in. So while people may associate a higher risk, there is so much of opportunity that is coming out in the road space that you will be able, it's not that I want to participate in every single project. So I will only pick up projects which makes sense to me, and where at the end of it I need to have a good night's sleep. So I don't want to end up having something. And what we have built incrementally, besides sector capabilities at the stage of underwriting, but we have built our own post-funding, post-sanction, post-disbursement monitoring tools around each sector to pick up early warning signals and take corrective action. So it's not only about originating right or underwriting right, but it is in terms of monitoring it through the life cycle of the project. And that is where you will end up picking better exposures in sectors people may perceive are more risky.
I think your example was very, very well placed. So there would be several players in the road sector who we don't deal with, and there are several who we do. And I hope that's why you understand I didn't want to, because my client is in that industry. But there are pharma companies we would not want to bank with. There are IT companies we would not want to bank with. Now, those are known to be very highly rated sectors. They wouldn't be on anybody's negative list if there is a negative list. But that's why I said we look at the good quality in every single industry, and you will find good players in every single industry.
Yeah, I'll just go towards the middle first, and then
Just one last question. There in the last couple of years, and based on con calls that we've had, the corporate banking focus has largely been on working capital financing and maybe on shorter duration loans. Is the focus continues to be on that, or are you open to?
Not in the last couple of years. If you went 5-6 years back, you would probably be right. But over the last 5 years or so, the corporate bank has looked at increasing the duration of the book in a selective, cautious way. And term exposures have now grown to a reasonable proportion of that book. They all remain within the same well-rated entities that you just saw. So they are all focused into that space. But it's not so I would say since at least 5 years or so, the corporate bank has been moving into longer maturities, into project loans, some infra, some manufacturing. It's quite a good mix of these.
Yeah, so just to add to what Jimmy said, term is not only infrastructure, term is also manufacturing companies. Term is also somewhere where you're not taking a project risk. It can be a completed project. Term is also where you are relying on a balance sheet funding, that there is a new capex requirement for the corporate, but existing cash flows are capable of repaying the debt even if the project does not generate 1 rupee of revenue. So there are a lot of things that go behind. And what is more important is it's easy to build a term book, but what is more required is in terms of maturity while you are building the term book. So at this particular point in time, we have triggers in terms of the rating of the client, how much is going term. So at a portfolio level, the system will start throwing out triggers if we are doing anything which is not within our risk appetite. So if you end up doing too much of lowly rated guys term exposure, the scores will start going up and it would come into amber or red. If you are doing too much of term vis-a-vis even with better rated companies, there would be triggers that would be thrown. So there are control mechanisms that are built in that while you may create a portion of your book as term, but you are not unduly taking more risk than what you are typically used to from HDFC Bank.
What is the average?
If you don't mind, we'll just move around. Yeah. Seish, you have the mic. I'll come to you as well, sir. Thanks.
Yeah, thanks. So I just wanted to discuss the competitive environment in the corporate banking segment. My understanding is that a large part of your success in the last 5-7 years has been taking share away from PSU banks, and that's been driven by two factors. One, that the PSU banks themselves have been constrained by capital and resolving their NPA issues, and your superior technology. Reason number one is the PSU banks, especially post the couple of private banks, their liquidity also has improved, so they are in a position to start growing. I'm also hearing, from a couple of corporates that some of the PSU banks are seriously upping their technology game by outsourcing to tech companies, etc. So have you sort of run that gamut of taking market share away from PSU banks, or that funnel that you referred to in slide 20? Is there still a large opportunity to take market share away? And what role does the expanded distribution that Shashi was referring to play in your ability to penetrate more corporates?
Okay, so let me try and answer this in three parts. First is, today competition was intense in corporate bank even 25 years back, was intense 20 years back, and continues to be intense even today. What is changing is the way corporates are looking at dealing with the bank. And it is, today everyone wants to reduce their touch points. Today, there was a time wherein you would see a typical consortium of lenders to a large company with 20 lenders. And today you would find that they have all cut down their dealings with 8 to 10 banks. Second thing is, there has been this new current account circular which says that you can only run operational banking with banks who have more than 10% share of your total funded needs. So when you look at it, there were banks with marginal share but were present in those banks. So it is not about what they are offering, but are they material to the customer's needs? And that is where some of the stronger banks who offer a wide array of products tend to benefit at the cost of smaller banks. And that is where one part of the growth that is going to come in. Second thing is, a product by itself will not sell. So I can believe that my eNet platform is the best, my TON platform is the best. But in terms of the effort it takes to go across to the client, make him familiar with the product, help him, handhold him through the initial days. And today for a corporate and a large company, it is not about going to the head office. Today my relationship managers travel the length and breadth of the country. They would visit 12 plants of the client to ensure that they start using a digital product and do it. So that is where the execution part of it also plays a role in addition to the product itself. Third thing is, in terms of today for a company, it is important what kind of quality of engagement that you have. So we are a financial supermarket, and I can offer everything, right from a debt and capital market requirements to working capital to advisory to salary to foreign exchange. And the quality of that interaction is very important. So at this particular point in time, if you look at it, corporates typically used to keep borrowing foreign currency because it was cheaper. But if you have followed what happened, one, the US interest rates went up before Indian interest rates went up. Two, forward premiums were very high. So on a fully hedged basis, it was a lot cheaper for someone to borrow in rupees, even for an export-oriented unit. And then you can sell dollars, your effective cost of debt would be cheaper than the dollar debt that people were selling. Now someone needs to keep looking at opportunities and arbitrage that is available in the market and advise the customers in terms of what are the possibilities that they have. Similarly, there are regulations around ECB refinance. So and a lot of companies ended up taking ECB at a time. But today, if someone was to cover their LIBOR risk or after a year the SOFR risk, the cost of that particular debt is substantially higher. So if do they meet various criteria of RBI to do refinance? Now this is where engagement is very different. Today the conversation that you have, so you have a client in the cement industry. I can go and tell him, okay, give me cash management, give me payments, and the customer says this guy will come and only talk about one particular thing. But if you engage with him very differently, saying that this is what is happening in the industry, this is the area where growth is, this is where you should be looking at a grinding unit, this is where you should be looking at a clinker capacity, the conversation and the value that you bring to that particular conversation is going to differentiate whether you deal with a manager finance or a director finance. It is going to differentiate whether everything else being equal, who gets the business. So our effort is to change the narrative and engagement with clients, and that's the differentiating factor for us.
Thank you, that's great.
Just
Can I
overshot.
add a small word to what he said? I think throughout our history, and I think I used to be in the corporate bank with him right in the beginning, I don't think we ever looked out for who's weak and who we can go after. So I don't think that's how we've looked at it. We've actually looked on the other side of the clientele, who's strong and who can we go after. And that is what you need to succeed in this. You obviously need the product range, which we have. You need the reputation and the longevity of your business, which we now have, and in the earlier days obviously was much harder. And you need perseverance and determination, and you need the tenacity never to give up, because these are very hard clients to break into.